Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to the show. Today is a special episode, and I'm excited to discuss the tremendous opportunity that is presenting itself to investors in the commercial real estate space. We're going to be going over market research that we have done internally at our real estate firm. And for the shrewd investor prepared to take advantage of where we are at in this current market cycle, there is poetry in motion in the multifamily sector. As Mark Twain once wrote, history doesn't repeat itself, but it often rhymes. Over the next 3 years, nearly $2 trillion, approximately 42% of the $4.7 trillion market of commercial real estate loans are set to mature. I'm going to repeat that. 2 trillion, 42% of the $4.7 trillion market of commercial real estate loans are set to mature. And what does that mean? Well, in commercial real estate, you don't have 30-year loan products. You typically have 5-year, 7-year, or 10-year adjustable mortgages. And so every 5 years, it balloons. And that landlord, that owner, has to refinance. Now, as we all know, over the last few years, rates have increased tremendously. This represents a significant challenge for investors who acquired commercial properties from 2020 to 2023 with short-term or floating debt, as they may face the daunting task of refinancing in an environment where interest rates have risen considerably, and lenders are tightening their underwriting standards at the same time. Notably, since March 2022, the federal funds rate has risen 525 basis points, which has resulted in a temporary disconnect in the multifamily market, presenting a unique investment opportunity to acquire property at a discount, despite the multifamily market robust fundamentals. Now, to date, we have already seen indicators of this coming to bear, as many funds have frozen distributions to their investors and are stockpiling cash. So the question today is, how do you participate? You, the listener, you, the investor, yielding real cash flow. How do you participate in this very large market? Because these assets are big. These are 10, 20, 30, 50, $100 million assets. So unless you have that kind of capital on the sideline, you have to figure out how to access these investments for a reasonable investment amount. And you can do it a number of ways. That's today's discussion. You could jump on the stock market, look for stocks, publicly traded real estate investment trusts that are at a discount. Pretty hard to navigate because it's a lot of research to figure out, are they at risk? And if you buy the wrong one, that could fall apart on you. And you won't know it till a quarterly report. But that's one way. And it's certainly liquid, and you could invest as little or as much as you want. The other way is to group together with some friends and go out and buy one of these buildings at a discount. And that would be through a private syndication. Or you can also find private real estate investment trusts in which you could invest into a real estate investment trust that's just starting. And that's my personal game plan. Gary's on board, and others that we know, we've been through these cycles, that establishing a syndication or a real estate investment trust at a market bottom, we don't know that we're there yet, but we certainly know we're not at the top anymore. You can strike a great basis and then allow the market to recover. So Gary, I want to hear from you. You've been an investor yourself for many years. We've invested together in syndications. We have a forthcoming real estate investment trust to launch this year. That's very exciting because, frankly, I've been waiting for this opportunity for 25 years. I haven't seen a market opportunity like this since the mid-90s after the S&L crisis, when commercial real estate got rocked and you saw prices depreciate 30, 40, 50%. And even in 2008 and 9, Commercial got hit, no doubt, but not like this. This has the potential to be a once in a lifetime or a once in a career opportunity. So, why don't you share your thoughts from your experience investing and now that you will have the opportunity as an investor to invest in these big buildings?
Yeah, Andrew, it's amazing. $2 trillion. I can't even count up to 2 trillion. I mean, you say that number out loud, but that's a huge number. And people are going to be in some deep trouble. And we talked about not catching the knife as it's heading down. And we've looked at properties here locally, and we still see prices that are inflated, and people that don't want to reduce their price, and they're just going to leave it on the market and watch it just fall and fall. So it's going to get serious here very quickly. And we'll talk more about this. We'll actually talk a little bit about what God says about, um, you know, what you should do as an investor. Um, and we spoke a little bit about it today, and I'll bring up some scriptures next week. But take a look at Ecclesiastes 11:2 at our next podcast. But look that up where God talks about dividing your investments in many places. So if you're somebody that just loves stocks, or you love precious metals, or you're heavy into whatever it is, maybe it's real estate, maybe it's something else. Um, I think this is the time to really look into the future, and the election's going to dictate a lot of what's going to happen here in the next couple months. So I think people are going to be in a panic mode. You're going to be driving by a lot of shopping centers and see leasing signs, and you're going to see your favorite restaurants with signs that say no longer here or move to another location, as rent and leasing prices are still extremely high, and it makes it tough with the current economic situation, and how much we're paying people to stand there and serve a sandwich for $20 an hour. It's not going to take very long for that to catch up, and we're definitely in a volatile situation right now. So this is going to be interesting.
You're spot on, Gary. And we've seen this movie before. We know how it ends. And it may look different. It always does. History never exactly repeats itself, but all the indicators are there. And this is not opinion. This is economic data. This is the facts. We receive this information through great services like CoStar, which we subscribe to as real estate professionals. And certainly we have our ear to the street. We have a nationwide company that operates in 25 different states. We hear the information from the people that are conducting the transactions. They're letting us know, hey, there's a problem. There's a storm on the horizon. We have a problem with the owners being able to refinance. And so I do want to go over some charts and facts. And I understand you may be listening and want to review this for your own. And so we'll put some links for you. And if you need to reach out to us, we have white papers that are written on these topics, one specifically to the entire commercial real estate opportunity, and then one specific to the multifamily commercial opportunity. And it's quite a long white paper, but it's very informative, and it's based and rooted in fact and data. And I want to credit a good friend of mine, our investment director, that's Nick Bonner, for spending time and effort and putting together and crafting a beautiful research project that we can share with investors so that they can make some decisions. And as Gary said, prepare themselves for what is coming down the pipeline. Not only is it an incredible opportunity, but it also is a form of a hedge towards inflation. Real estate has always been that hedge. Now, buying a peak price, not such a great hedge. That's more like deflation. But in this circumstance that we see lining up in the next 3 years specifically, we believe that's the window of opportunity. It could extend. It could be 4 or 5 years. That really comes down to the policies that get put in place with the next administration that goes into office, and also what the Federal Reserve decides to do with those interest rates. But we know even if they continue on the path they're on, there is going to be some carnage, some wreckage, and some opportunity here in the next 2 to 3 years, just by the sheer amount, the volume of loans that are coming due. So the bottom line is this: commercial real estate loan maturities are at a record high. Of the 900 billion in commercial real estate loans maturing this year, multifamily accounts for the largest portion, which is 257 billion. Roughly 85% of the commercial mortgages that were due to mature in 2023 were extended, increasing the total loans coming due this year by 271 billion. So you can already see that the lenders last year in 2023 did not want to face the music. And they simply said, you know what? You're not going to be able to refinance that. Let's go ahead and kick this can down the road. And that was only about 14 billion, but still big number. Now we have 271 billion that is supposed to be refinanced this year. Now we're a little bit past mid-year, we're into the late summer. So this will come to fruition by the end of this year. And if we see that this gets kicked down the road again, well, we all know when Wall Street and the banks try to push stuff down the road, it just blows the bubble up even further. So this trend is expected to continue through 2024 and into 2025, but eventually the music will stop and the lenders are going to need to address the devalued assets on their books. Now, according to CBRE, loan defaults will be concentrated in office, which suffers from high vacancy and low demand, and in multifamily, where many investors who financed acquisitions at ultra low interest rates face significantly higher debt servicing costs as those loans mature. So let's take a quick recap of what the different asset classes are in commercial real estate, so people have context of just how big of an opportunity this is and what specific types of commercial real estate to be looking at. So you have multifamily, as we mentioned, that's the largest, right? We have $900 billion coming down the pipeline this year. And then, and that's all the debt that's there. And then in 2025, you're going to see this taper off, 2026 taper off, and through 2027 all the way to 2032 it gets back to somewhat normalized levels. But the different types we have: multifamily, office, industrial, retail, hotel, and healthcare. Those are the primary places in commercial real estate to be looking. Now, the largest opportunity, as we mentioned, that is in multifamily, and certainly right alongside it, neck and neck, is office. If you have an appetite for risk that is not conservative, well, then you want to take a look at things like office. But understand that with office, there can be more and more vacancy. The work from home trend continues, and you better be capitalized to hold on for the long term because of the operating costs that go with an office building. In my professional opinion, you have a golden opportunity with multifamily, which is already cash flowing, that's already providing yield and income and a cap rate. And simply just this adjustment in the interest rate cycle will be presenting these properties at a discount. So that is plenty for us and our investors. We are happy to take on those assets at a discount, receive the cash flow. We don't need to necessarily swing for the fences by buying up very risky assets. But there is more on the horizon. So industrial and retail have not yet felt the pinch. So even if you can't act right away and take the current opportunities, start to pay attention as hotels, retail, industrial, and healthcare follow suit, because there will be opportunities in all these different asset classes. So Gary, I want to get your thoughts. You've been in the residential and commercial space for a long time, but mainly in that multifamily and residential space in your sales career. You've seen people build wealth just by buying up single family homes, condos, some, duplexes, triplexes, some small units. But that barrier to entry for most people is they can't break into the commercial space. And that's typically defined as at least 5 units, but really it's once you get over 16 units where you have a resident manager on site, you get to 20, 30, 40, 50 units. That seems unattainable for most people because they don't have the capital to exercise that purchase on their own. But what are your thoughts and your guidance? What advice can you give to a listener that might just have, a few 100,000 laying around, but they do want to participate. They want access to this opportunity.
Yeah, really, the best way to do that. And my parents did really well. They figured it out early, many, many years ago, and they got into the multifamily units, 2 to 4 units, which is small. But when you don't have a lot of money to invest and you've got a job and you're just investing small, that's a great way to do it. And a lot of my clients have done really well with that. Now, what I'm going to be doing is calling all my clients and saying, "Hey, we've got a great opportunity now to get into this market. And as we see prices decrease, we'll be able to purchase these large properties, as you said, Andrew, 16 units, 20 units, 30 units. This is going to be ripe for somebody that can't afford to do that and maybe has $100,000, $200,000. Taking a look at the REITs, and this is a great time. I know you've studied this and you've got charts, and we're really looking at a prime market. So we're going to be putting together a list. I am personally of my clients that would like to get into this market but could not afford to get into it. This is the best way to do it right now is to talk to one of us, and we're preparing for it. We've got the charts, we've got the slides, and we do have properties that we've identified. A lot of those have sold already, but that's okay. There's going to be plenty more coming down the pike.
You got it. I mean, when I think about my career of over 25 years as an investor in the real estate space, and I reflect back on the wins, the mistakes, the learned lessons, the number one thing I think about is what if I had simply just bought and held? I did a lot of investing in all different asset classes throughout the real estate journey. But if I had simply just bought things like multifamily buildings and just held on to them in perpetuity with the understanding that unless there was a compelling reason, there's no reason to sell. Well, in reflection, that would have been a better strategy than buying and fixing and flipping and 1031ing and moving all this money around. Because at the end of the day, if you find the right spot, meaning geographically located, the right demographic shift going into a market where people are moving in and jobs are increasing, and it's an industry or a city that's going through a transformation and industries are coming, well, it's going to be very hard to rewind time once the word is out and buy at those prices ever again. You might get one or two opportunities like we're seeing right now, but that's it. And we live in an area, San Diego, California. I've been here for 30 years, and I came from the San Francisco Bay Area, right outside Silicon Valley. So I've seen both of these areas absolutely boom and blossom since I was born in the 70s, right? And to watch the growth, you learn so much about how demographic shifts and how population growth and industry growth directly impacts the real estate prices around you. And the other learned lesson, looking back these 25 years, and I openly share my track record. So for people that are curious, I'm happy to send it over and show people what we've done. We have fantastic returns. We've done very well. But again, I'm always looking at what could I have done better? How could the performance have improved? And when I look back, the other mistake that I made that I'd like to share with the listeners is I tried to do things myself. That was a big mistake. I should have got into LLCs, real estate investment trusts, partnerships, grouped and aggregated my capital earlier in my life because I was stuck where so many listeners and investors are stuck, which is in that residential space or 2 to 4 unit space. And the issue with that space at large is that those assets were never designed to be true investment assets. 2 to 4 units, yes, a little bit, but they're still subject to a lot of residential owners who want to buy and live in one and rent out the other two. And so there's always this emotional thing that goes with the residential investments. And for that reason, they get way out of whack from a cash on cash return basis. The cap rates never ever line up with true commercial real estate. So once you get out of that zone and you get into the, say, 5 to 20 units or 50 units, 100 units, 200 units, or even retail shopping centers and office and so on and so forth, then you're in an asset class that was always designed to yield cash flow. Obviously, you need to be very careful and choose wisely. Make sure you're with the right managers or the right partners. But getting into one of those assets versus playing around in residential, trying to do all the, fix and flip. And it's maximum effort, in my opinion, for minimal result. Why not do the minimal effort for the maximum result? And that comes through group syndication or investing in real estate investment trusts. So, Gary, learned lessons. We've gone into syndications together, and again, very successful. But wow, what a tremendous amount of work to yield those returns. And we want to give credit. We have some investment partners, specifically two of them, Sharon Seymour and Christine Durr, who these ladies worked so hard as the managing members of the last syndication we put together, and they delivered excellent, excellent returns. I'm so impressed. I taught them how to syndicate and kind of shepherd and guided them. But at the end of the day, it was their blood, sweat, and tears that resulted in an incredible performance in this LLC. But we all look back and say, yeah, if we had just simply bought, 7, 8 years ago, and we're in this space and held, what would the returns have been? And would that have outperformed what we did? So sometimes less is more. That's the bottom line. But Gary, as you look at this as an investor yourself, you were part of that syndication, and you have been diversified, as you mentioned with that great biblical scripture earlier. What are you most excited about with this golden opportunity where you will be able to own pieces of big assets that are 20, 30, $40 million discounted from 50, 60, $70 million, like half off sale? What are you most excited about?
Yeah, this takes me back to when I was a kid. Actually, I'm still a kid when we played Monopoly, and this is big boy Monopoly. So now you can actually own that. Well, we're not going to probably buy hotels, but we could. But this gives you an opportunity as a smaller investor to take a little bit of that cash, maybe that you have in the stock market, or maybe you've got a 401k, a K plan that is not doing what you'd like, and you'd like to take that money, which you certainly could, and invest into a REIT. So this gives the smaller investors more opportunity to get into the bigger commercial multifamily space. And as you see that chart that Andrew's talking about, which you can't see it here, but we can certainly go over it with you. Um, that space is going to open up, and it's going to open up wide. I think Andrew was wise over the years as he's taken AARE as a company, and he certainly could have leased out in many different areas, space that were, we could go and meet, and he actually had the forethought to invest into executive office suites. So instead of having a huge monthly, it's a smaller monthly, and you're sharing it with other people. This is the same concept. And you need to be wise with your money, and especially what's coming up, now with the economy the way it is, and grocery prices and gas prices, you need to be smart with your money. So we've got a lot of exciting things, a lot of exciting investments coming forth, and I'm looking forward to being a part of that myself.
And we're opening it up at large. One of the beautiful things that happened in our organization is that we took our company public a few years ago. And so, for those listeners who don't know me personally or don't know our story, I was a single shareholder for 20 years. And then we did file with the SEC, and we are a bona fide public company. We're not publicly traded yet, but we are destined for that at some point. And so, the point is that we are able to open up this opportunity to a much wider audience. And we went from one shareholder to over 100 shareholders in a very short period of time. And that demonstrated to us that there is a huge appetite and demand for the type of offerings that we present. And we're excited to share this one with our listeners as well. Now, there is so much to unpack here, and we are going to produce several episodes during this late summer season as we get closer to the fall, closer to the election. We've been talking about precious metals, and that was a golden run that we just saw. We've got some pullback now. We'll keep you posted on that. But we are going to transition out of that space, if you will, because frankly, it's been a great run, and I think there could potentially be more of a run. But hopefully, you were listening to the episodes and took some off the table, and you can now look at what's the next season ahead. And in our opinion, and it's based and rooted in fact, it's not just me and Gary with our, experience in real estate for 20, 30 years, but really, what we've seen over these previous market cycles, this next 6 months especially, we want to focus on real estate, and we will bring up some other things in the stock market, the bond market that relate to real estate. But the reason being is because these golden opportunities only come around every decade or so. We saw it in COVID for a very short period of time between March, when COVID kind of hit the world and everything shut down, till about June, July, when the Feds dropped the interest rates all the way to zero. And then there was actually a boom and a recovery. There was a short window of 3 or 4 months where you could pick up real estate like 20, 30% off. It was like pick your favorite store and walk in, and there's just a sale on everything. And we haven't seen any of that. We've seen only appreciation and high prices, especially in residential, ever since. But in commercial, this is it. And you want to pay attention and learn during this season. And hopefully you're in the position to participate. As Gary said, there's wonderful options. If you've got a self-directed IRA or 401k, it doesn't necessarily only have to be after-tax dollars sitting in the bank. You can also group some people together, and you're going to learn, just like we've previously published in recent episodes, about what real estate syndications are, how to group together the securities laws that you need to follow, and really the organizational structure to set you up for success. But the bottom line is this: there is so much more to follow, and we are going to continue with these episodes and educate you and give you the information you need to execute. So we hope this message has blessed you today, and stay tuned, because there is much, much more knowledge that we're going to share over the next few episodes on the real estate opportunity at hand.